Hi, I'm Roger Montgomery from the Montgomery Fund, and welcome to this week's Video Insight. As the Dow Jones surpasses 17,000, questions are being raised about how long it could go on. Do we have a bubble at the moment? In order to have a bubble, there are often various markers. Now, it's true that it's only after the event that we can point to those markers and say they were the early signs that we're in a bubble. But the reality is there are some very obvious signs of a bubble long before there's ever any burst. Right now, we're just not seeing them. I'll give you an example of a marker. So we may look back one day and realise that the app that raised $1 million from investors that does nothing more than send the word yo in an example of context-based communication, we may look back on that one day and say that was in fact a marker of bubble-like conditions. But it's also true that technology stocks like Amazon were trading at 1,400 times earnings earlier this year in January, and they're no longer at those levels. Still very high, but a long way from their all-time highs. Now, in order to have a bubble, we need everyone to think that they're going to make a lot of money. In fact, John Kenneth Galbraith, in his book, The Great Crash, once said that in order for a bubble to be evident, you need everyone to throw every fundamental reason for ownership of property out the window. So enjoyment of its use, income from the property, even its long-run worth. None of those factors remain relevant. All that becomes relevant is that the price will go up next week and next month as it went up last week and last month. I think right now there are as many people concerned about bubbles and concerned about crashes as there are people throwing caution to the wind. So we don't have that very, very important marker. And Alan Greenspan, in a subsequent book, actually said that what's more important than the bubble conditions is how they're actually funded. In order for any contagion from a bubble bursting to affect the real economy, we need to see very, very high levels of debt. And in the stock market, that's another marker that we simply don't have. The margin lending practices that we saw before 1987, in 2000, and before the GFC don't exist today. What really matters for a bubble to burst that's toxic is high levels of debt, or if you like, monthly repayments. And that's just not a big factor right now. And perhaps most importantly, and we wrote about this last week, Janet Yellen, the chair of the Federal Reserve of the United States, has indicated in her recent speech to the International Monetary Fund that she is not concerned about bubbles forming. She believes that the system is sufficiently robust, the financial system that is sufficiently robust that it can withstand any bubbles subsequently bursting. That means that monetary policy is not being set to avoid an asset bubble and not being set to avoid its subsequent demise. In other words, I think we could expect to see the market grind higher. And finally, where is the market today in the valuation cycle? Well, we believe it's about 10% overvalued. Given that valuations are just a rough estimate anyway, you could say it's as close to fair value as it is to slightly overvalued. In other words, the possibility of grinding higher prices is very, very possible. And with Janet Yellen's help and the Federal Reserve help, that's what we'll see before we see any busting. I look forward to seeing you again next week. In the meantime, please follow us on Facebook and Twitter.